Hey everyone, and welcome. You've definitely heard it on the news, right? A country's GDP is up, its GDP is down. It gets treated like this ultimate scorecard for how an economy is doing. But what is gross domestic product? What does it actually mean? Well, today we're going to dive into national income accounting and crack the code on that one big number.
So, imagine you see a headline. A country has a GDP of $25 trillion. I mean, it's just a massive, mind-boggling number. But what does that even mean? How on earth do they calculate something like that? And what's it got to do with, our actual lives? Let's find out.
Okay, so to get that final GDP number, you can think of economists as detectives. They don't just use one single method. Nope. They attack the problem from three completely different angles. And the whole point is to see if all the clues from all three angles point to the very same conclusion.
And here they are, our three angles of attack. You can measure everything a country produces, or you can measure everything people and businesses spend, or you can measure all the income that everyone earns. Now here's the cool part. The theory is that in a closed economic loop, these three numbers should be exactly the same. Let's see how that's even possible.
To make this super simple, let's create our own tiny economy. It's got just two companies in it. That's it. Firm A is a cotton farmer, and they sell $50 worth of cotton. Firm B is a cloth maker. They buy that $50 of cotton and turn it into $200 worth of finished cloth that people can buy.
So, our first detective method is the product method. The key phrase here is value added. This is so important because it's how we avoid counting the same thing twice. You just look at what a company created at its specific stage. You take its final sales and subtract the cost of the materials, the intermediate goods that it used to make its product.
Let's run the numbers. Firm A, the farmer, didn't have any material costs. They just grew the cotton. So their value added is their total sales, $50. Now Firm B, the cloth maker, they sold $200 worth of cloth. But remember, they spent $50 on the raw cotton. So their unique value added is 200 minus 50, which is 150. You add them together, 50 plus 150, and the total GDP for our tiny economy is 200.
Okay, detective angle number 2, the expenditure method. This time, we're not going to look at how stuff was made. We're just going to look at the very end of the line. We are simply adding up all the money that was spent on finished goods.
In our simple two-firm world, this is really easy. The only final good sold was the cloth. The cotton, that was an intermediate good. So the total final spending in the economy is just the $200 that people paid for that finished cloth. And look at that, we get the exact same number, 200. Two methods, same result. The evidence is building.
And now for our final angle, the income method. This one makes a lot of sense when you think about it. Every single dollar that's spent on a product has to end up in someone's pocket, right? It becomes income for somebody, either as wages for an employee or as profit for the business owner. So this method just adds all that income up.
So let's follow the money. Firm A earned $50. It paid $20 in wages and kept $30 in profit. Firm B added $150 in value. It paid $60 of that in wages and kept $90 in profit. So now let's add up all the income. Total wages paid were $20 plus $60, so $80. Total profits were $30 plus $90, so $120. And what's 80 plus 120? You got it, 200. Three totally different methods, one identical answer. Case closed.
So now we know how that big number is put together. But the headline GDP figure you see on the news isn't always the most useful one by itself. To really get what's going on, we have to look at the fine print and make a few really important adjustments. First up, you've got this battle between nominal and real GDP. Nominal GDP is simple. It uses today's prices. But that can be misleading. If prices go up because of inflation, nominal GDP goes up too, even if we didn't actually produce anything more. Real GDP is smarter. It adjusts for inflation by using a fixed set of prices from a base year. So if you want to know if an economy is actually growing, are we making more stuff? Real GDP is the number you want to watch.
Next up, we've got GDP and its close cousin, GNP. The difference is all in one letter, D for domestic versus N for national. GDP is all about location. It measures everything produced inside a country's borders, even if it's a foreign-owned company doing the producing. GNP is all about ownership. It measures everything produced by a country's citizens, even if they're working overseas.
Okay, this is all great on a huge national scale. But how do we get from these trillion-dollar numbers to the money that people can actually spend? How do we connect the nation's total output to what really ends up in your wallet?
You can think of it like a journey or maybe a waterfall. We start with that massive national number at the very top, and then we go through a series of steps. We subtract things that don't actually reach people's pockets, and we add things that do, until we finally arrive at the amount that households have left. Let's walk through it.
All right, here's the path. First, we take our national product number and subtract something called depreciation. That's just the value of all our machines and buildings wearing out for the year. Next, we make some adjustments for taxes and subsidies to get to the true national income. From that, we have to take out money that doesn't go directly to people, like the profits that corporations keep. But we add back money that people receive from the government, like social benefits. And finally, we subtract personal income taxes.
And that finish line, after all those adjustments, is personal disposable income, or PDI. This is the bottom line. It's the total amount of money that all the households in a country actually have left in their bank accounts to either spend or save. This is the number that connects all that huge macroeconomic stuff to our daily lives.
So we figured out how GDP is calculated, how it's adjusted, and how it connects back to us. But all this leads to a final, really critical question. Is a bigger GDP always better? Is it really the ultimate measure of a country's success and well-being? Well, it turns out the answer is pretty complicated.
The truth is, GDP has some major blind spots. For instance, is all that income being shared fairly? What about all the incredibly valuable work that happens for free? And what about the hidden costs, like damage to the environment, that don't show up on any balance sheet?
First, let's talk about distribution. The source material says it perfectly. If the GDP of the country is rising, the welfare may not rise as a consequence. And that just hits the nail on the head. You could have a country where GDP is booming, but if all that new money is going to just a handful of people, most of the population isn't any better off. GDP shows us the size of the whole economic pie, but it tells us nothing about how the slices are being divided up.
Next, GDP only counts stuff where money changes hands. This means the enormous amount of valuable work that gets done inside homes every single day. Cooking, cleaning, taking care of kids or relatives, it's completely invisible to the official numbers. It doesn't count. Same goes for any kind of bartering or informal trade. This means GDP is almost always underestimating a country's true economic activity.
And finally, there's the big problem of hidden costs, or what economists call externalities. So, imagine a factory that makes a product. GDP is great at counting the value of that product, but what if that factory also pollutes a river, harming public health and the local environment? Well, that's a very real cost to society, but GDP completely ignores it. It only counts the economic positive, not the negative side effects.
So, at the end of the day, GDP is a powerful and useful tool, no question. But it's not the whole story, not even close. It measures output, but not necessarily outcomes. It measures the quantity of economic activity, but not the quality of our lives. And that leaves us all with a pretty big question to think about. If GDP isn't the whole story, what else should we be measuring to get a true picture of progress?